Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich by Krish. You know, we're going to tackle a topic today that can feel, well, a little overwhelming. But honestly, it's absolutely crucial for your financial future. We're talking about mutual funds. And today, we're going to cut right through all that jargon and give you the tools you need to invest with real confidence.
So, have you ever felt like you need a translator just to understand what's happening with your own money? Yeah, you are definitely not alone. The whole world of finance is just filled with this alphabet soup of terms, alpha, beta, NAV, that makes it feel like some kind of exclusive club with a secret handshake you were never taught.
And you know what? That feeling of intimidation, it leads to a huge problem. So often, we end up making major financial decisions based purely on what's familiar. We hear a colleague at work talking about some hot stock or a great plot of land during a tea break, and just because it feels safe and familiar, we jump in. But you've got to ask yourself this question. Is it really the right investment for you, or is it just the one you've heard about?
I actually have a name for this. I call it the tea break finance problem. And this habit of making these unexamined decisions, it has a real tangible cost. It might feel like the easiest path to take, but let me tell you, it almost never leads to your actual destination, financial security. And here is the direct consequence of that. Following the crowd often leads to becoming asset rich but cash poor. What does that mean? It means your net worth might look fantastic on paper, but if all your wealth is locked up in things you can't sell quickly, like real estate, it's pretty much useless when you need cash for an emergency. And that, my friends, creates anxiety, not peace of mind. All right, so how do we fix this? How do we move from just reacting to office chatter to proactively building real wealth? Well, it all starts with understanding how to properly evaluate an investment, like a mutual fund. We need to look beyond just the past returns and really learn how to read a fund's behavior. Okay, so let's get into it. We're going to start with two of the most important tools for this, beta and alpha. Now, the best way to think about these is that they help you understand a fund's personality. Seriously, beta tells you how it dances with the market, while alpha tells you if the fund manager is actually a good dance partner. So let's break down beta first. Just think of it as the fund's sensitivity to the market's mood swings. Let's say a fund has a beta of 1.2. That means it's about 20% more volatile than the market. So if the market has a great day and goes up 10%, your fund might have an even better day and go up 12%. But, and this is a big but, if the market has a bad day, your fund is going to feel that pain even more. It's a measure of the risk you're taking on. Now, let's talk about alpha. To me, this is like the fund manager's report card. It tells you if all their hard work, their research, their stock picking skills is actually generating returns above and beyond what you'd expect just from the market's movement. A positive alpha. That's the proof that the manager is adding real value for the fee you're paying them. And speaking of fees, this is the next really critical piece of the puzzle. The costs that are tied to a fund, they're often hidden in plain sight. And believe me, they can have a massive, massive impact on your wealth over the long term. The key thing to look for here is the expense ratio. It's this small percentage that gets deducted from your investment every single year. It covers everything from the manager's salary to research costs. The sneaky part? You never get a bill for it. It's just taken directly out of your returns, which is why it's so incredibly easy to overlook. And that expense ratio, that's the main difference between the two ways you can buy a mutual fund, through a regular plan or a direct plan. A regular plan includes a commission for the distributor who sold it to you, which makes its expense ratio higher. A direct plan, on the other hand, has no middleman. You buy it straight from the source, so its expense ratio is lower. Now, you might be thinking, come on, it's just a 1% difference. How much can that really matter? Well, let's look at the magic of compounding. This chart shows the staggering impact over 30 years. That seemingly tiny 1% difference, it can cost you 60 lakh rupees. 60. That is the silent power of compounding, but this time it's working against you. But the choice isn't always so simple. That higher fee you pay in a regular plan, it pays for professional guidance. Just imagine this. The market suddenly drops 20%, and at that exact moment, you urgently need cash. Panic starts to set in, right? A good advisor's job is to be that calm, unemotional voice, guiding you on which assets to sell first. And that could potentially save you from making a very costly, fear-driven mistake. Okay, on to our final technical pillar for today, taxes. Look, Understanding how your investment gains are taxed is absolutely essential for smart wealth planning. Because at the end of the day, what truly matters isn't just what you earn, it's about what you actually get to keep. So here's a simple breakdown. For equity funds, if you sell within a year, your profit is called a short-term capital gain, and it's taxed at 15%. But if you hold on for more than a year, it becomes a long-term capital gain, and that's taxed at a lower rate of 10% on any gains above 1 lakh rupees. Now, debt funds are a bit simpler. Your gains are just added to your income and taxed at whatever your personal slab rate is. And this brings us to a really crucial strategic point. In what's called a dividend plan, you pay tax on the dividends as income every single time they're paid out. But in a growth plan, all the profits are just reinvested back into the fund. This lets your money compound without being taxed year after year until the day you finally decide to sell. For long-term goals, this is just so much more powerful. So let's take a breath. We've covered a fund's behavior with alpha and beta, we've looked at its costs through expense ratios, and we've talked about the taxes you'll pay. But what does all this technical knowledge really get you? It gets you a simpler and honestly a more powerful philosophy for building real wealth. First things first, let's ground ourselves in reality. Forget about chasing those 25 or 30% returns you hear people bragging about. Over the long haul, a realistic, healthy expectation from equity mutual funds is around 12% per year. Wealth building, it's a marathon, not a sprint. And just adopting this one mindset can change everything for you. And that brings us to the real core of it all. True success, it comes from combining this technical knowledge with the right behavior. It's about linking every single investment to a specific goal. It's about staying disciplined when the markets get scary. It's about trusting the process and understanding that consistently investing over time will always win. And ultimately, this is the goal. All the charts, all the numbers, all the technical details we talked about, they're just tools to help you achieve this state. Real wealth, it's not a number in an app. It's the financial peace of mind that lets you sleep soundly at night, knowing you've planned well for your family's future. You know, this learning journey never really ends. So, I want to ask you, what are you still curious about? Drop a comment below and let me know which financial concept you'd like me to break down in our next explainer. Let's keep the conversation going. And hey, if you found this explainer helpful, it would mean the world to me if you'd subscribe to the channel, like this video, and maybe share it with someone you know who's ready to take control of their financial future. Thank you so much for watching, and always remember the goal: live rich and leave rich.